Hey everybody, Steve Antonioni here. Just wanted to pop on to talk about the current state of the markets. I had actually had a different video planned to release today, but I thought with kind of everything going on this week and a bunch of you guys messaging me asking about kind of what's going on here, I thought that I would just give you my thoughts on the state of the current affairs. So let's just jump right in. So over the past week and the past little while, actually, we've been seeing a lot of pain in the markets, but only so far actually in certain areas of the market. If we're just talking about something like a broad index like the S&P 500, well, have we really fallen that much? Not really. Like, we're looking at about a 2% drop since the start of the year, basically. Like, the S&P 500 has not really rolled over or anything like that. And in fact, throughout the past year, it has just bulldozed straight upwards, delivering a very easy 23% return. However, if we look into high growth stocks, tech stocks, things like that, we can see that a company like Square has basically fallen off a cliff at this point, down something close to basically 50% here, 48%. That's pretty crazy. If we look at ARK, one of the absolute darlings of ETFs last year, pretty much when I called the top in it in my warning video here for talking about how ARK ETFs might be a little bit ahead of themselves at that time. You can see that we've fallen about another 45% there. And even a stock like Shopify, we are down about 30% since the last high. However, a stock like Tesla, one of my favorites, is actually showing quite a bit of resilience here, and that's because they actually have some very strong catalysts and they've been performing very, very well. And you can see they've returned 30% over the past year, beating the S&P 500 index, so that's always what you want to see in a high growth stock like Tesla. And so the NASDAQ as a whole is down about 7% or so right now. And of course, finally, we see that crypto has absolutely fallen off a cliff, with Bitcoin now down quite a bit since its all-time high. I think let's see here, it's down, yeah, like 40%. So that's a really big fall, similar to what we saw in the summer. But the interesting thing about the crypto markets is there are some actually pretty uncorrelated assets here. You can see that Phantom has been performing actually very strongly, even though Bitcoin has pretty much fallen off a cliff. So Phantom's actually been one that I've been accumulating, so I'm pretty happy about that. But there are others as well. You can see that Atom is also doing a similar thing, and I also own Atom. We'll talk a little bit more about these later in the video. But for now, if you're holding any of these high growth stocks, if you're holding any crypto, or even if you're just holding broad market index funds, you might be still growing a little bit concerned, wondering what the heck is going on here. Why is there so much volatility in the markets? Why does it seem like a lot of stocks are falling very rapidly? Well, if you've been watching my videos, especially some of my recent videos, then you'll know that we've been talking about this for a while. You can see a bunch of videos here that I posted like a month ago, talking about, even 2 months ago, talking about how some of these things might come to happen in the market. And the reason this is happening, and I've talked about this before, but now it's actually starting to happen. So before I was talking about that this might happen, now it's actually starting to happen. So basically what's happening here is, man, I'm saying happening and not, sorry. The Federal Reserve is basically transitioning in a number of different ways. So over the past while, we've been living in an environment with a ton of quantitative easing. Well, now it sounds like they're going to be transitioning into quantitative tightening. This is the opposite of quantitative easing. And on top of that, they're thinking about raising interest rates as early as March. So in a nutshell, this is basically like turning in the complete opposite direction of the environment we've been in before. The environment we've been in before is this very easy money environment. That's why, you know, all the memes that sprung up over this past little while, like stonks only go up, all of that stuff, it's because we've been in this very easy money environment. There's so much money flowing into the markets. If the Federal Reserve continues on this path, there's a chance that the opposite could happen, that a lot of money could actually flow out of the markets. And the reason that that happens is because you can see here on the 10-year treasury yield, we've gone up a little bit towards the end of last year, beginning of this year. And when this goes up, it basically changes the way that investors look at the risk and reward of investing their money in markets like the stock market. And the reason why is because when bond yields go up, bonds become more attractive to invest in. You have to look at it like this. If bond yields are super low, it means that you're not gonna get much yield on your bond. So you have to go look other places for yield. So a lot of people would take their money that they might have invested in bonds and they would otherwise instead go take it and put it in the stock market because that was the only place they could get a decent return. But now if bond yields start to go up, well, hey, a lot of investors will think, I can get a pretty good yield now on bonds, which are much less risky than stocks. So I'm going to move some of my money. I'm going to reallocate my capital so that the risk reward makes a little bit more sense for me. So the basic idea here is as bond yields go up, some money generally flows out of the stock market because there is opportunity for yield elsewhere. And the areas where this will affect the stock market the most is especially in companies like Square is a really good example here because you can see the PE ratio on Square is currently 152. And if it's currently 152 when they've already fallen like 40%, you know that when they were up here at like 280, their PE ratio was much, much higher than this. Stocks with a very high PE ratio right now, basically meaning that investors are looking very far out into the future to earn a return on their money, they're probably going to get hurt the most by this transition to higher interest rates. And the reason they get hurt so much is we have to remember how a market functions, how a market actually functions. And I think this is a really good example of that. So this is basically a website that allows you to see the bids and the ask for Bitcoin. And I'm using this as an example because it's just a really good visual. So we can see here on the right where there's this red and green. These are all actually the orders that people are trying to place. The red is people trying to place orders to sell Bitcoin, and the green is people trying to place orders to buy Bitcoin. So a market, all a market is this battle between buyers or sellers. This is how prices are actually determined. So basically, when you see a stock selling off, it's because in this battle, there are much more sellers. There are much more people trying to get out of this particular asset. And that's because a lot of people are worried that this easy money period is over. So there is immense selling pressure on a lot of the higher risk, higher growth, longer duration investments like growth stocks and crypto. Now, speaking of investing on easy mode or the easy money period, honestly, you can still invest on easy mode. You pretty much always can. Just look at the S&P 500. Like, look at that last year return. If you are down on some of your stocks, you should look at the S&P 500 and think to yourself, would I have just been better off owning the S&P 500? In most cases, most people are. That's why the vast majority of my money goes into index funds like the S&P 500. So honestly, if you're having a hard time in the markets right now, like I would consider looking into index ETFs if you haven't already. I talk about them a lot on my channel, so if you're new here, make sure to subscribe and watch some of my older videos on them. You can pretty much just dollar cost average your way into the markets and then just go about and enjoy your life. But for everything else, it's a good idea to have some type of like pre-investment checklist that you use before you jump into an investment. You should have an idea of why you're actually buying this thing. You should have a thesis. So for example, I'm going to walk through a few quick key points of why I really like investing into Tesla as a specific individual stock. I have a thesis on this that I've formed. So Gary Black on Twitter recently put out this really great tweet that shows how Tesla is not actually super overvalued like a lot of people think it is. He's basically saying here that in 2023, Tesla is trading at about 54 times earning according to his estimates. But Tesla is currently growing at about 50% year over year. So he's saying that there is no other mega cap company, a company worth over $200 billion, trading at 1 times price to earnings growth. A lot of people don't understand the growth of Tesla. They just can't wrap their heads around it, or they don't think it will continue. But for the people who do understand it, it gives you an edge because so many people are consistently betting against you. So many people are consistently taking the other side of this trade or not taking the trade at all, which means in that battle between buyers or sellers, you can have an edge because you understand information that a lot of people don't. And to illustrate that further, let me show you something really, really interesting. So in 2021, Tesla delivered about 1 million electric vehicles. If we compare this to Volkswagen, which is one of the big behemoth automobile manufacturers, they produced about 9.3 million vehicles in 2020. But just for simplicity's sake, we can say that maybe, Tesla's produced about 1 million and Volkswagen sells somewhere around 10-ish million. So basically, Volkswagen sells 10 times the cars of Tesla. And with Volkswagen selling about 10 times the cars worth of Tesla, we can see that they profit about somewhere between 10-ish billion to about 20-ish billion over the past few years. So if we put these numbers into just like a super simple chart, just to illustrate the point here, we have Tesla selling 1/10 the vehicles of Volkswagen. But look at this. Tesla is on track to earn an annualized profit of about $5 billion as of the production they are producing today. Volkswagen, with 10 times the production of Tesla, is only earning a profit that's about the same or 4 times bigger. That's a huge discrepancy there. So you can just map this out for yourself and just think, I wonder what happens when Tesla gets to the point that it's selling the same number of vehicles as Volkswagen. And you can see that they are going to be far more profitable than Volkswagen is. This is what a lot of people don't get about Tesla. This is why it doesn't really make sense to compare them to somebody like Volkswagen, but so many people do. So many people just can't wrap their heads around this. And so many people can't wrap their heads around how fast Tesla can grow its production capacity. You can see here, Wall Street had anticipated about 267,000 deliveries for the fourth quarter, but Tesla actually delivered 308,000. That's a huge beat over Wall Street. Wall Street consistently gets this wrong. They consistently get Tesla wrong and underestimate them. So this is good for me as an investor in Tesla, and I honestly hope this doesn't change anytime soon. Maybe everyone's still looking at GM to be leading the world in EVs with a whopping 26 sold in Q4. Yep, great job guys, you're really leading the charge. So when you have a thesis like this, when you've done the work to research what you're actually investing in, you can be very comfortable when the market goes down, because when the market goes down, you know that that's a good buying opportunity for you. But if you're investing in things that you don't really have a good answer for why you're investing in them, well then when the market goes down, you tend to feel kind of worried. And I've done that, and I still do that sometimes. There are times when every investor realizes, you know what, I actually don't have a really good answer for why I made this investment. I don't understand this as well as I should have, and I think that this was actually a mistake. And I think that's totally okay to admit to yourself, and I honestly think it's totally okay to sell something if you do come to that realization. I think there's honestly a little bit of toxic behavior that goes behind this whole buy the dip mentality, because if you're buying the dip on something that you don't understand or that you don't actually have a really strong conviction on, you might just be digging yourself into a deeper hole. That's why I'm a huge believer in really sticking to position sizing rules. Position sizing is what is going to save you from making massive mistakes. If you start off with small positions in things that are a bit experimental or things that you're still researching but you want to have a little bit of capital in, you're not going to get burned if you decide later, you know what, I don't actually have that strong of a conviction on this thing. If your position size is very small and it goes down a lot and you sell it, it's not that big of a deal. This is what happened for me in my crypto portfolio with Cardano. I did quite a bit of research on it, and so I decided to buy it at a time when I thought it was a good time to buy it. It seemed like there was a lot of fear. But as I began to actually use some of the blockchains in the crypto world and actually kind of get my hands dirty and stuff like DeFi, I realized that Cardano might have not been the best decision for me, because these other blockchains seem to be a lot more promising in this particular moment. And so I came to the conclusion that, you know what, I actually don't have that good of a reason for why I bought this. And sometimes you have to admit that to yourself. And sometimes you have to say, there are much better places that I could have my money right now. And because it was such a small percentage of my portfolio, I didn't lose any sleep over selling this and taking the loss on it, especially after actually using some of the applications built in the blockchain world, like DeFi Kingdoms. You can see that the price of Jewel in DeFi Kingdoms has done extremely well, and that's because it's a really cool project. I'm much happier having my capital invested in here with something I can actually use and understand much better. And speaking about DeFi and these other kinds of things in the crypto world, I've been talking a lot about these on my Instagram. I've been posting a lot of stories about this stuff, and there's been a bunch of you guys who've been really interested in learning more about it. I'm thinking of maybe starting a Twitter page to kind of talk more about this, and we can have like a little sub community where we can explore these things together more. So if you're not already and you are interested in things like decentralized finance and want to learn more about that, make sure to follow me on Instagram, because at some point I'll put out an announcement about the new Twitter account, and then we can explore that world together over there. And with all that said, that's basically some of the thoughts that are kind of running through my head right now about the state of the markets. And for me, basically what I'm doing right now is just sticking to the same old plan of vast majority of money gets dollar cost averaged into ETFs, investing on easy mode. Some other money gets allocated to high conviction things like Tesla. And then I'm using a very small amount of money right now to explore some really fun, cool things in the world of decentralized finance and kind of like GameFi and things like that. So I hope this was helpful for you. I know it was a bit rambling, maybe a little bit all over the place, but thanks for tuning in, and I'll see you again soon.